Netflix just reported amazing earnings, beat on EPS, beat on revenue, ads growing faster than expected, 325 million subscribers globally, and the stock is down 5% after hours, down almost 30% in 6 months. So the question isn't, is Netflix broken? The real question is, what is the market suddenly worried about that most people are ignoring? Because the sell off is not random. I wanted to buy Netflix. I've followed this company for years. I've owned it before. I've also made the mistake of buying great businesses at the wrong price, thinking cheap meant safe. But when a stock drops after clean earnings beat, that's usually not about headlines. It's about forward risk. And that's where things get interesting. Let's go through the bull case for Netflix once. EPS beat, 56 cents versus 55 cents revenue beat. Ad revenue up 2.5 times year over year to $1.5 billion. Management expects ads to double again by 2026, 325 million paid global subscribers, still the dominant streaming platform, all true, all bullish. Right now, the popular narrative is the stock is down because of uncertainty around the Warner Bros. Discovery acquisition. I don't buy that. Netflix has already lost over $200 billion in market cap since that deal was announced. The acquisition price is $81 billion. Whether the deal happens or not, the market has already punished the stock. This sell-off is about something else. This earnings report had four things that made me uncomfortable, and discomfort is information. Risk number one, revenue. Growth is slowing. Explicitly, Netflix guided 12% revenue growth for 2026. That's down from approximately 15% over the last 2 years. Maybe they're being conservative, maybe they want an easy beat, but here's the problem. Netflix is still a premium multiple business. Markets tolerate high multiples only when growth is accelerating or at least stable. Deceleration plus premium valuation equals pressure. This is not about panic. This is about math. Risk number two, engagement growth is weak. Relative to spend management said members watched 96 billion hours in the second half of 2025. Sounds huge, but it was only up 2% year over year. 2%? Netflix has spent aggressively on content, live events, boxing, WWE, sports adjacent programming. Why? Because live content reduces churn. If you're waiting for a fight or an event, you don't cancel. That strategy makes sense. But if engagement is growing just 2% while content spend keeps rising, that's not leverage. That's maintenance. Netflix's market share has been flat around 8% since 2023. Meanwhile, YouTube continues to gain. This doesn't mean Netflix is dying. It means the moat is no longer expanding. Risk number three, competition is forcing higher spend. This comment from management mattered more than people think. We are seeing increasing competition driven by innovation. They also guided for higher content expense growth in the first half of 2026, which is unusual. Historically, Netflix spent more in the second half. Spending earlier tells me something subtle but important. They feel pressure now, not later. When great businesses start pulling spend forward, it's usually defensive, not disastrous, just less comfortable. Risk number four, buybacks are paused. Netflix has stopped buying back shares to preserve cash for the WBD deal. I actually agree with this decision. Diluting shareholders while funding an acquisition with equity would not be great. But the reality is, shares outstanding are no longer declining. That removes a quiet tailwind the stock had. Again, not fatal, but one more support removed. Valuation versus reality. Cheap is not the same as safe. Netflix trades around 34 times trailing earnings, approximately 28 times forward. Earnings. I personally believe looking at Netflix, I think Netflix is a good buying opportunity at today's price. It's much better than what it was at 110. I'm mainly using some of the analyst numbers. If we take 20% EPS growth rate for the next 5 years, PE ratio right now is around 36 times. I'm using 30 times as an exit multiple over the next 5 years. I believe that's a little bit high, but it's still fair. I'm getting right now with about 17% compounded annual return over the next 5 years, which is a really good return if you were buying Netflix today at $83 per share. But here's the uncomfortable thought. What if Netflix matures into a 25 times earnings business? That's not crazy. Growth could slow down. Microsoft trades around 26 to 27 times. Meta trades closer to 21 to 22 times. If Netflix ever re-rates to 25 times, the stock is not cheap at $83. It's cheap closer to $65 for you to generate 17% compounded annual returns over the next 5 years. I personally wouldn't be surprised if Netflix falls to $65, and that would potentially be my buy point. That's my view, not advice, just how I'm thinking about risk. If you disagree, tell me why. If you see something I missed, I want to hear it. Hit like if this helped you think more clearly, not more emotionally. Subscribe if you value calm, honest investing. See you next week.